Hey everybody, welcome back to the Credit Street Financial channel. I'm here today to drop an amazing credit gem per usual. But before I get into today's topic, I really would appreciate it if you can like, comment, and subscribe for your girl, because that really does help me out. And I'm able to continuously put out more content on credit and finances. It just makes it a lot easier. So today I'm going to be talking about reasons why you are still getting denials for your credit or loans when you apply, even if your credit score is good. I'm going to go over some misconceptions about credit scores as well, because a lot of people think that having a high score is the main factor when it comes to decisions, and that is not the case at all. Having a high credit score does not guarantee an approval, a better rate, or any of that. There are many other factors that lenders consider besides your score when lenders are looking at your credit file. And one of the things that they really look at is to see how good your buying power is. I see firsthand all the time with my own clients. I've seen clients have a 670 credit score that have way better buying power than someone with a 750 credit score. And so what that means is lenders would prefer to work with and give better rates to the person with 670 rather than the person with 750 credit score. And that's because the 670 client has better buying power. So before anybody argues with me, I do want to say, of course, having a high credit score is wonderful, but what's not wonderful is having a high score with little to no borrowing power. To be honest, your high score means absolutely nothing if you have no borrowing power attached to it. And so some of you may ask, well, what is borrowing power? Borrowing power refers to the amount of money or credit that a financial institution or a lender is willing to lend an individual. So here are 7 reasons why your borrowing power can be low. You may be getting denials even if your credit is a 650 plus. Number 1, too many inquiries. By having too many inquiries on your credit file, that does raise a big red flag, and lenders may think that you are desperate for credit. If a bank or lender sees too many inquiries, they may draw a conclusion that you're taking on more debt than you can handle. So you really want to go in and apply with very minimal inquiries. I would say having less than 5 per bureau, my recommendation. Number 2, having high utilization. If you're showing that you are using most of your available credit, lenders may see you are a risk. So you want to aim for 30% or lower prior to applying. That way you increase your better chances at approval and better chances at getting better rates. Number 3, lack of credit mix. So before I get deep into what lack of credit mix is, I do want to address something, because this topic comes up a lot when it comes to my clients, credit repair, etc. Many people believe that paying off an auto loan can actually help your credit, but really so many people are surprised when they see their credit drops once they pay off their auto loan. The reason why is because they are not maintaining a credit mix once the item is paid off. Lenders do like to see a variety of credit types, both installments, so that's a loan, something with an end date, personal loan, auto loan, mortgage, student loan, those all have end dates. And they also like to see something revolving. So that's a credit card or a line of credit, something where you pay it and you get that amount back, and you have this available to you. There's no end date to you. It's always revolving. So relying solely on credit cards or solely on loans can really hinder your chances at approval, because you're not having that credit mix. You want to have a little bit of both. So if you do pay off your auto loan, then I would recommend getting a personal loan or just something, that is showing it has an end date on your credit file so you can get your score back up. Again, lenders like to see that you can handle different financial obligations. So number 4, debt to income ratio. If you claim you don't make enough money to cover your debts, that's a red flag for lenders. In this day and age, it's really important to include your household income when stating how much you make on an application, because if a lender sees that you have other financial obligation, which 90% of people do have more obligations when they're applying for stuff, and they see that you're trying to get a $25,000 loan, and let's say you make $45,000 a year, then chances are you will be met with a denial. I would consider using household income when filling out applications. Number 5, too much new credit. Opening too many new accounts can also hinder your chances at approval. Lenders are concerned that if you open too many new accounts in a short period of time, you may be taking on more debt than you can manage. Lenders may see that as you overextending yourself financially, and they may think that you might have difficult on-time payments. It's not enough data for them to go off of if everything is too new. So lenders may also think that you're desperate, and they may wonder, why do they all of a sudden need so much new credit? Are they facing financial difficulties? So that definitely can lead to denials. Number 6, too much personal information. Having too much personal information on your credit report, meaning having excessive names, addresses, phone numbers, employers, can make you seem less stable. When there are multiple names and multiple addresses listed on your credit file, it can create confusion and make it more challenging to confirm your identity. And lenders do like to see consistency. So the rule of thumb is 7 years. If you have more than one address every 7 years, I would clean that up on your credit file, which is super easy if you just go to Experian, Equifax, and TransUnion and just clear up that personal information. 90% of people do have multiple addresses, multiple employers and phone numbers, all of that. So definitely want to clear that up before you go and apply for stuff. And number 7, putting self-employed on your application. Historically, self-employed borrowers have shown higher likelihood of defaulting on loans compared to traditional employed individuals. Some lenders may be cautious of that. So if you're writing self-employed on your application, I highly recommend that you do not do that. Lenders typically prefer borrowers with stable and predictable income because it really just provides that assurance that borrowers can make regular payments. So if you are self-employed, I would recommend putting your business name and a job title like manager or something like that. But you don't want to leave it at self-employed alone. So if you recently applied for credit and they denied you and your credit score is 650 plus, then more than likely it was because of one of the above reasons that I mentioned. So all in all, a high credit score is very, very essential, but it's not the only factor when getting approved for loans or credit. Remember, lenders also consider your financial health and your credit behaviors, your debt to income, all of that is considered. So by understanding these additional factors and maintaining a well-rounded credit file, it's going to increase your chances of getting approvals and not having an inquiry on your credit report for nothing. So that's all I got for you today. And if you found this video helpful, don't forget to hit that like button, share it with anybody that may have recently experienced a denial, or share it with anybody that may need some credit help. For more updates, you can follow me on TikTok and Instagram. Everything is Credit Street Financial. Please watch out for the spelling because there are some fake accounts out there. That is Credit Street Financial, all one word. My TikTok looks like this. All the other ones you may see are fake, so I'll make sure to link it in the description. Also, I just started a private Facebook group where I will have some exclusive credit tips and information in there. I'm also going to put that in the description as well. Thank you so much for joining me today. I really appreciate it. Till next time, bye.